For more on this, we're joined by Mpho Molopyane, who's the chief economist at Forbes. Mpho, good afternoon. Thanks very much for your time. Apologies for the delay. Inflation has ticked up to 4-month highs in February, reaching 5.6%. Does this mean that the Reserve Bank may push back the cutting cycle beyond July this year?
I mean, that certainly raises the risk that interest rate could be pushed out much further. But I think at the moment, it's also important to keep in mind that the SARB is more forward-looking. So they will be looking at to what extent do the recent inflation prints affect the outlook on inflation. So at the January meeting, they were expecting that inflation is going to average about 5% this year. So we'll then have to see what revisions they make to that inflation profile, and that will then certainly dictate whether interest rate cuts will be, how much interest rate cuts will be cut this year. But we certainly still expect some interest rate cuts in the second half of the year. I think the quantum and quantity, the quantity and pace of those cuts is what's at question at the moment.
What are your expectations of the outcome of this afternoon, looking at such factors as the rand-dollar exchange rate, oil prices, among others?
So our expectation is that, one, we are expecting the SARB to keep interest rates unchanged at this meeting. I think the focus is going to be on forward guidance. What are they going to tell us about what to expect for the remainder of the year? What will be important at this meeting to keep an eye on is their inflation outlook, their growth assumptions. It will also be important to hear what they say about international interest rates, because that does affect emerging markets. And we do know that this past week, a lot of central banks and advanced economies did somewhat indicate that they might be nearing the beginning of their cutting cycle. So those deliberations should certainly feature in today's MPC meeting. But from our side, I'm expecting that inflation is likely to be adjusted higher because all prices have ticked up somewhat slightly. We've had inflation surprises in the first 2 months of the year. There's also concerns around food inflation as well. So that could certainly add some upward pressure on the forecast that the SARB presented in January. And on the back of that, we think that they're likely to remain slightly hawkish and pushing back against imminent rate cuts, which essentially means that we're going to see interest rate cuts in the second half of the year, not first half.
Remind us again of just how much interest rates have risen since the tightening cycle began almost 2 months ago.
Well, the interest rate cycle began in 2021, right? And you would recall that, interest rates had been cut quite significantly. And at some point, we were even looking at interest rates at about 5%, but those have significantly increased, and we're looking at interest rates at 8.25. So we've had over 300 basis point increase in interest rates since the hiking cycle started.
Borrowing costs at their highest since 2009 in South Africa, good for people with investments, but bad for those who are in debt with credit cards, loans and bonds. What should consumers learn from this period? I mean, I think, we shouldn't be wary. I think interest rate cuts are certainly on the horizon. As I indicated earlier, it's the quantum and the pace of those cuts that are now at question. So I think for now, consumers should continue tightening their belts. I'm not too sure to what extent that people can continue tightening their belts. But inflation has also eased, right? So inflationary pressures have certainly eased. We're not seeing the upward significant increase in inflation. So, there is hope on the horizon, and consumers are almost likely going to get a reprieve in the second half of the year.
Hope on the horizon. Now, GDP growth forecasts always start high and are revised downwards. What can we expect this time around from the bank?
On the growth front, I'm not expecting significant changes, and this is because since the last MPC meeting in January, we did receive the fourth quarter GDP numbers for 2023, but they were pretty much in line with market estimates as well as our very own estimates, and which showed that growth for 2023 averaged 0.6%, which was pretty much in line with what the SARB was expecting at the January meeting. So we certainly think that the growth outlook is likely to remain unchanged, with growth still expected to average about 1.2% this year. So a slight recovery in growth.
Mpho, let's leave it there for now. Thank you so much for your time and insights.